Now let's talk about this decline. Um, just checking out some of the things I like to check out in these situations. Um, I think people usually get really scared when declines come quickly, but they get less scared if declines come slowly. And this is like a Bayesian phenomenon. If you look at chart of the S&P, you really have to be crazy to think that um, this represents some massive drop. And I think like this looks pretty bad, but so did this. This looked like it was all over. That was just 2 months ago. And if you scroll back to a year, this kind of starts to feel a little stupid. Like, okay, we went from here to here, but the chart starts down here. If we go back even further, you can barely see this drop. So, and do you remember this drop? I guess that was all may not be useful here. Well, so we've kind of had this like straight line up for since 2008, in essence, other than COVID. Um, and we actually had this like huge over investment in this 2021 period that we're still digesting, quite frankly, in my opinion. So again, like if you look at a 10-year chart of the S&P, I don't see what anybody is really concerned with or thinking about. But that's because of the Bayesian inference of humans. We tend to overthink new information. And we tend to react poorly to new information, integrate it poorly. And this is no exception. Like market's down a lot in the last week. Well, markets kind of like part of what markets do is they gyrate, and this is hardly. It really depends on what you think the trend line is. Like even the '08 drop looks like meager in retrospect to the general trend of the S&P, which has just been up and to the right forever. It doesn't mean that you can't have like a multi-year period where prices decline, and I do think you have to be prepared for that. But again, with short selling, there's really a sort of solution there. The other solution is cash. If you don't want to short sell, or you don't think it's a great idea or whatever, you can certainly do cash or puts or something like that. There's always that sort of option. But we can start talking about individual stocks as well. But in terms of macro, there's a few more things to look into. I have to open the door because my cat's upset. First she cries if the door is closed. Now she cries if the door is open. It's just unbearable. Okay, so one of the things that's worth looking at is the yield curve. And then there's also a couple of other kind of important pieces of information. You've got the political kind of dynamic as well. I'm just trying to take a look at some of the CDS and yield curve and stuff like that. Like CDS is another way to look at if there's real fear. VIX is one thing, but like look at the CDS on important stocks or countries, and that's kind of more interesting. When people start talking about countries defaulting, that's when I get excited. We're pretty far away from that. Let's see where the Italian CDS is. 74 basis points. That's nothing. So you want to make a real fortune, start buying these CDS. Start spreading some rumors. That's what I'm talking about. I'll make the whole country of Italy crawl to its knees. What's up? Is it over for BTC? No, it's not over for BTC. But I think your portfolio should be able to withstand years and years of pressure. And if it can't, you shouldn't be investing. Why did Buffett sell Apple? Buffett made a lot of money in Apple. Apple management. Usually, I mean, I think his new stock pickers, which aren't really involved in Apple, but Buffett's also very old now. I think he may be planning or thinking about death. Um, in a lot of ways, I don't know what his thinking is specifically on Apple. I'm sure we'll find out soon. I can ask around, but I mean, it's a huge position. He's up a lot. It's not crazy for him to trim it. I mean, I actually think Apple's fine. They're doing quite well. But let's get back to bonds. So typically the bond market's like more sophisticated and more interesting than the stock market. So the 10-year is trading at 3.7. Bonds are being bid up right now for obvious reasons. And then the 2-year. All right, can you hear me now? Switch to the another mic. Um, Sorry, I'm on YouTube as well, so some of people may not understand some of the things I'm doing or saying. So yeah, the yield curve is slightly inverted, which is a little worrisome, but that's a signal that is not that reliable. So yield curve inversion doesn't always precipitate a market decline. So keep that in mind. But that's one of the things I look for. There's the TED spread as well. So like if liquidity is getting bad, that's something that's worth looking at. And the TED spread's been very quiet. So there's plenty of liquidity. And I think they got rid of the TED spread. What's the new TED spread? I'm such an old person. It's like sad. TED spread's gone. Yeah, there's kind of a couple of other different TED spreads, but um, basically looking for. Hold on one second. Um, so basically, this decline is in essence just like you had a bunch of stocks that were up a lot, and now they're up a little less, but they're still up a lot. And I think that's probably a good way to look at it. Um, and in these situations, like typically, I would start to cover shorts and buy the stocks I like more. The problem is that Once you start doing that, you lose your downside protection. And if you do that, it can be pretty ugly. You should kind of like try to keep all those things in balance. What else should we look at for recessions and things like that? I mean, corporate spreads are interesting to look at too. I don't like to play vol. Vol is a professionals game that professionals play. You know, I like to like play games that I know how to win and stuff like that. Here's the vol chart on Bloomberg. It's pretty wild. But again, you know, rapid price change may not be as meaningful as a not rapid price change. So, you know, we tend to overthink these things. Like if you look at HRH or something like that, and you look like a weekly return histogram. You know, we're probably going to read in the 1 sigma range. Maybe the 2 sigma range this week. Is 2 sigma enough to freak you out? I don't know. And there's plenty of stocks that aren't really trading that crazy, right? Like look at Visa or the video game stocks, eBay. Oracle's down 4%. It's not that big of a deal. I think it's just the beta stocks are down a lot. The Nvidias and Teslas. I mean, anything like tech related. Let's check in on biopharma. Biopharma is usually like a safe haven in these situations. Like AbbVie's barely down. J&J's up. In real crashes, every stock goes down, even the safe havens. So I really don't think there's a lot to worry about here. If you're worried, I think market tone is like my favorite idea in the stock market. If you're worried about this decline, what's going to happen the next decline? You're going to be jumping out of the window? It doesn't make too much sense. If every decline scares you that much, then I feel like, you know, you should probably reevaluate, you know, your perspective on investing. Like I said, I mean, if this 550 to 511 is enough to freak you out, I don't know what to tell you. Now, if we go to 450 or something, then I'd say that's, you know, or 475 on the SPY or something like that. Then I'd say, okay, that was pretty brutal, pretty quick erase of a lot of upside. But I would still say, let's say you needed to, I could probably draw on this chart, but let me do it a little simpler so you guys can see, you know, which chart is worse, this guy in the black line, or which chart is better or worse that I'm drawing, or, you know, I'll superimpose for a minute and then I'll do this. And basically, I'm just drawing two lines. The red line goes higher than the black line, but rapidly converges to the black line. Which is better or worse? Well, the problem with the red line is you emotionally get very kind of excited about this big upside it had, and then the crash back down to the black line, or the trend line maybe, is very frustrating. But the integral, the area of the curve of the red line, I'm just going to color it in. This is the
point of calculus in some ways, is to figure out areas under curves. But this area under the curve is actually like sort of profit potential for you in a lot of ways, at least unrealized. And so, all of this should be joy. And the fact that it returns to mean, if anything, is you should have known you're sitting on cloud nine. And that's where we were for a while when Nvidia went up every day, and there was people posting giddily about it. Well, this is the reversal of that. So, and it doesn't mean that we can't go right back up. We certainly can. So we can look at a couple stocks if you guys want. I like this. Real yield curve steepening is the real recession sign. Hard for me to understand that. Okay, somebody said SoFi. Somebody said Tesla. Let's do Tesla real quick, just because. Scotty, you're welcome to talk anytime you want.
Hi, Martin. I was just wondering, do you know the recommended height of building to jump from to guarantee death?
Yes, I do. Higher is better. But again, the market's calmed down quite a bit in the last 5-10 minutes I've been talking. Apple's down 5%, for example. Amazon's down 5%, not that much. Salesforce down 3%. Google's down 3%. These are pretty modest losses.
Yeah, this isn't too bad. But do you think this is just a precursor to?
We don't know.
Income?
I mean, that's the beauty of markets. We don't know. If we knew, it would be easy. But I think it's important to sense frothiness. Like, I went max short like 2 weeks ago because this is going to sound really strange, but basically the Bitcoin strategic reserve was something I helped plan, and when news got leaked of it, the Bitcoin did not go up at all, which was really strange because I thought it was the most bullish news possible for Bitcoin, so that the US government would be buying it. That's kind of a big deal. And then it kind of like went up like 0.5% or something, and it was like that was what some traders call market tone, and the tone basically showed that everyone was already long Bitcoin, or like nobody felt like they wanted to add to their long based on that news. So in essence, if all the market participants are long and they're all aware of some news that is supposed to be bullish and that they're not reacting, the only thing you could do there is sell everything in short. And basically that worked. But somebody asked, how did you help plan the Bitcoin Strategic Reserve? I had the idea. But yeah, I mean, the SaaS stocks aren't down too much, for example. It's just Nvidia, some of the stocks that have been up arguably too much or cooling down a little bit. This is not something to worry about. And I would put crypto in that category, right? Like crypto is by definition like a high beta imaginary asset. You know, when shit hits the fan, you can go to Pfizer and be like, all right, people still need their medicine, right? I'm not going to stop taking my cure for my rare disease because the S&P 500 is down. You know, as long as I'm employed or I'm on Medicare, I'm still going to get my drug. And employment doesn't massively change even during terrible recessions. So drug companies, consumer product companies, these are kind of safe havens. And if you think people want to be in Bitcoin during a big recession or something like that, they don't. Because you can't rely on the cash flows of Bitcoin like you can rely on the cash flows of Pfizer or Merck in a big recession. People are going to still take cancer drugs. They don't care about a recession. People are still going to take vaccines. Those babies don't care about a recession. They don't know a recession's going on. So, you know, you just have to keep that in mind, that when markets decline, usually it's the weirdest assets that go first. And Bitcoin and crypto are weird assets. You know, you can sell all your Solana and all your Bitcoin and buy Pfizer or something like that. I'm not saying it's a good idea. I like Bitcoin. But just to explain the phenomenon, you know, it makes a lot of sense that a meme coin is not going to be the safe haven. It's the most fringe asset on the frontier curve of assets. You know, it's the highest risk, highest reward. Things like Pfizer and Merck are boring. That's why people don't trade them as meme coins. They're really boring, but that boring nature is the dependable nature. They're literally the stalwarts because they're fortresses. Coca-Cola is another one. So what stocks are almost all bargains today? I don't think of things that way. You know, I think of one, I mean, you have to look at the differential between these. So like, if the market's discount rate goes from, I don't know, let's say, well, we actually know a little bit about what happened today on yields. So let's say yields, which is what's called the risk-free rate, right? RFR, goes from 4% to 3.7%. Let's just exaggerate a little bit. Okay? But the equity risk premium, which is the premium we pay to buy equities, let's say that goes from, I don't know, 2% to 4%. All right? The market's discount rate, how much it discounts cash flow by implicitly, has net gone up, right? Let's say it's gone up from 6%, and I'm exaggerating a little bit here, to 7.7%. Well, that means that the cash flow of every single stock in America is down. The discounted cash flow value of every single stock in America is lower than it was yesterday. And you look across the stocks and okay, they're all down. And maybe it's not 6 to 7.7, it's 6 to 6.2. But every stock correspondingly, the cash flows from every future company are worth correspondingly less, then you don't really get a buying opportunity, right? Because the market says you should discount those cash flows more sternly. And at some point the market will say, no, discount those cash flows more liberally. But what really matters is, is one of these stocks going down way more than one of the others, and is that a mistake? Or vice versa. And I can't particularly tell you because, you know, you may think of things as, okay, stock goes down, bargain exists. Yes, in some ways that is true. If enough of it happens, there is some kind of like floor, but we're not anywhere near that kind of scenario where you can buy a stock for like 3 times earnings or something like that.